Hey friends, my name is Z and you're watching Yi Makes It Easy, and welcome to a new video for IGCSE Business Studies. And today we have 5.3 for income statements, and by the end of the lesson you should be able to describe 5.3.1 what profit is and why it's important, and for 5.3.2 income statements, which includes the sub-specification. So check the pin comment for all the timestamps, and don't forget to hit the like button, subscribe and ring the notification bell. And we'll move on to the first one, which is 5.3.1 what profit is and why it's important. Starting with what are accounts and why are they necessary. The financial records of a business are called its accounts, and they should be kept up to date with a great accuracy, and this is the responsibility of accountants working in the finance department in the business or company. And at the end of each financial year or fiscal year, the accountant will produce a final account of the business, and this will record the main financial results over the year and the current worth or value of the business. And limited companies are required by law to publish their final accounts, and these are much more detailed than those required from non-company businesses, such as sole traders and partnerships. And for recording accounting transactions, in most businesses, there are so many transactions each year that it will be very time consuming to record them all by hand in accounting books, and this is one reason why most organizations or companies now use computers. Computer files store records of all the sales, purchases, and other financial transactions made by a firm, and the information can be retrieved or printed out when required anytime. Then this is how a profit is made. Profit is an objective for most businesses, and in simple terms, profit is calculated by profit equals revenue, like the total sales minus the cost of making the products. This simple formula introduces the idea that a profit is a surplus that remains after the business cost has been subtracted, and if these costs exceed the revenue, then the business has made a loss, because it will be like a negative profit, which is a loss. And the profit formula also suggests that this surplus can be increased by, number one, increasing the revenue by more than cost. Number two, reducing the costs of making the products. And number three, a combination of 1 and 2 together. Then we have why profit is important to private sector businesses. And profit is important to private sector businesses for several reasons. And number one, reward for enterprising, and here's explanation. Successful entrepreneurs have many important qualities and characteristics, and profit gives them a reward for these. Number two, reward for enterprising. And entrepreneurs and other investors take considerable risk when they provide a capital to a business, and profits reward them for taking this risk by allowing payments to be made, like dividends. And these payments provide incentives to business owners to try to make the business even more profitable, and to investors to put more capital into the profitable businesses. Then number three, sources of finance. Profits after payment to the owners, or the retained profits, are a very important source of finance for a business, and this allows for expansion. And number four, indicator of success. When some businesses are very profitable, other businesses or new entrepreneurs are given a signal that investment into producing similar goods or services would be profitable, which is an indicator of success. Then we have more for the profit for private sector businesses. In public sector or state-owned businesses, profit might also be important, and the government might set profit as one of the targets to be achieved for these businesses. And these surpluses could also be used as a source of finance to develop the state-owned business or make it more efficient. In social enterprise, profit also has an important role to play. Social enterprises cannot survive unless they make a surplus from their operations, but a profit is not their only objective. The managers of social enterprise will want to balance off profit making with other aims, such as protecting the environment and benefiting disadvantaged groups in society. Then we have the difference between profit and cash. So here's a question and answer. Why is it important to remember profit and cash are not necessarily the same thing when looking at the business final accounts? And the answer is because just because a business records a profit, it doesn't mean it has plenty of cash. In fact, it could have no cash at all. And just remember that profit is a surplus after total costs have been subtracted from revenue. Hence, cash, also called revenue, is how much money a firm earns, while profit is how much money is left over after all expenses are paid. Then we have 5.3.2 income statements. So here are the main features of an income statement. And income statements, also known as a profit and loss statement, are important for financial statements. They indicate to managers, business owners, and other account users whether the business has made a profit or loss over a period of time. And this period of time is usually 1 year, but income statements could be constructed in a monthly basis. And if the business is making a profit, the managers will want to ask themselves these two questions. Is it higher or lower than last year's? And if lower, why is it falling? Why is the profit falling? And number 2, is it higher or lower than other similar businesses? And if lower, what can we do to become as profitable as other businesses? And number 2, if the business is making a loss, the managers will want to ask themselves these 3 questions. Is it a short or long-term problem? Are other similar businesses also making losses? And number 3, what decisions can we take to turn losses into profits? And then we have the main features of an income statement. We have revenue at first. And this is the amount of money made by the business from the sales of its goods or services. And it is calculated by multiplying price by the amount of goods sold. For example, if the price is $10 and 1,000 products are sold, then revenue is 1,000 times $10, which gives us $10,000. And ways of increasing revenue were considered in the marketing chapter, such as price and promotion, as we've seen a few lessons before. Then we have another main feature of an income statement, the cost of sales or the variable cost. The cost of sales is also sometimes known as the cost of goods sold, and it is the variable cost of production for the goods or services to be sold by a business. And this includes the cost of the materials used in creating the good plus the direct labor cost of producing the good. In the retail business, it will be the cost of the inventory sold by the shop, and it excludes fixed cost expenses such as distribution costs and sales staff costs. Then we have gross profit. What information do income statements contain? Before we can answer this, we need to consider an important concept known as gross profit, which is the profit calculated before the fixed costs are considered. So here are some examples. Number 1, we have if a business bought 270,000 worth of goods during the year and sold them for 450,000, the gross profit will be 180,000, which is just this value minus this value to get 180,000. Like the revenue, gross profit equals revenue minus cost of sales. And it is important to note the following. Gross profit doesn't make any allowance for overhead costs or expenses, and the cost of sales is not necessarily the same as the total value of goods bought by the business. Then we have more for gross profits. How is this information presented on an income statement? And this following table right here shows a simple example with some notes to explain each item. And it's mainly for a limited company, as these are the only business that have to publish their accounts. We have this income statement for this limited company, XYZ. And for the year ending at this, like the financial year ending or the fiscal year, we have this time period covered by the income statement must be shown. The revenue, and this is the value of goods sold during the year. For example, like 900,000 items for 50 cents each, right here. And the cost of sales, and this is the variable cost, like the materials and labor, for example, of making the goods sold. For example, 900,000 items costing 30 cents each, which gives us this cost of sales. And then we have gross profit right here, which is just revenue minus cost of sales, which gives us 180,000. And this section of an income statement is often referred to as the trading account. and it shows the gross profit made from the normal trading activities of the business. And what do you think is not a complete income statement? And there are several important items missing from this example. For example, are the costs of running the business apart from variable labor and material costs, like fixed costs, taxes and profit paid by the company, and payment of a share of the profits to owners or the shareholders. Then we have net profit. Net profit is calculated by deducting all expenses and overheads of the business from gross profit. Unlike gross profit, net profit will also include any non-trading income such as the rent from an apartment above a shop. And depreciation is a fall in the value of a fixed asset over time. This is included as an annual expense of the business. For example, a new truck bought by a building firm will fall in value with the age and use. And each year, this fall in value or depreciation is recorded as an expense on the income statement. So essentially, here's the difference between gross and net profit. Gross profit is revenue minus cost of sales, and net profit is gross profit minus expenses. So here's a case study example of an income statement, like with the gross profit, non-trading income, then with the wages and salaries, electricity, rent, depreciation, and these to get the net profit, which are the expenses. Then we have retained profit. The retained profit is a profit left or reinvested back into the business after all payments have been deducted. And the income statement for limited companies will also contain, number 1, corporation tax paid on the company's net profits, the dividends paid out to shareholders, and in some years dividends might be 0, or there might be no dividends at all. And number 3, the retained profits left after these two deductions. And number 4, the results from the previous year to allow for easy comparisons. And here's a case study as well, like a typical income statement. So here's just a recap of the income statement, like gross profit, net profit, retained profit. It's an important part of a company's published accounts used by managers and shows profit or loss and not cash flow. An example of the income statement. And here's using income statements in decision making. Managers can use the structure of income statements to help them in making decisions based on the profit calculations. And if a manager has to choose which of the two new products to launch, one way of making this decision is to construct two forecasted income statements. Like we have this, forecasted information for the next year: revenue, cost of sales, gross profits, rent, other expenses, and net profits for location A and location B. And here's some case study questions and some activities. Then lastly, here's some definitions for 5.3 for income statements. Number 1, we have accounts. And accounts are the financial records of a firm's transactions. Number 2, accountants. Accountants are the professionally qualified people who have responsibility for keeping accounts accurate and for producing the final accounts. Number 3, final accounts. Final accounts are produced at the end of each financial year and give details of the profit or loss made over the year and the worth of the business. Then we have income statement. An income statement is a financial statement that records the income of a business and all costs incurred to earn the income over a period of time, for example 1 year. And it's also known as the profit and loss account. Then we have revenue. The revenue is the income to a business during a period of time from the sales of goods or services. Then we have cost of sales. The cost of sales is the cost of producing or buying in the goods actually sold by the business during the period of time. And the gross profit. A gross profit is made when the revenue is greater than the cost of sales. And gross profit is calculated by revenue minus the cost of sales. Then we have trading account. A trading account shows how the gross profit of the business is calculated. Then we have net profit. Net profit is a profit made by a business after all costs have been deducted from the revenue, and it is calculated by subtracting overhead costs or expenses from the gross profit. Then we have depreciation. Depreciation is a fall in the value of a fixed asset over time. And lastly, for retained profit. Retained profit is a net profit reinvested back into the company after deducting tax and payments to owners such as dividends. And that's it for this video for 5.3 of IGCSE Business Studies, where today we look into income statements. And I hope you guys found it useful and helpful, and if you did, please leave a like and subscribe and ring the notification bell so that you don't miss out on any future videos. Also comment down below if you have any questions or criticisms and I'll reply to them. Also check out my Instagram in the description for more daily content. I hope you guys enjoyed this video and I'll see you guys in the next video. Until then, stay safe and happy learning.